All right, let's dive right into this explainer. The world's most efficient oil producer just quit the cartel. Now, if you think this kills energy stocks, you are reading the wrong balance sheets. Today, April 29, 2026, we are looking past those mainstream panic headlines to find where the real actionable alpha is actually hiding. We're talking about a fundamental paradigm shift here. The United Arab Emirates has officially announced its withdrawal from OPEC. That ends a 59-year membership that literally predates the nation's own founding. To put that into perspective, it's kind of like a founding member of the Justice League just suddenly deciding, you know what, I operate better completely solo. Now, the knee-jerk reaction from the market when a cartel fractures is almost always pure panic, right? Massive sell-offs, a million articles predicting doom for the energy markets. But today, we're going to look strictly at the underlying data. Because when you do, you'll see why this departure is a highly calculated masterstroke of sovereign strategy, and why this UAExit paradox might actually be the absolute biggest macroeconomic buy signal of the entire decade.
So the question literally everyone is asking right now is, does this kill energy stocks? Like I said earlier, if you think the UAE leaving OPEC is a bearish signal, you've got to look closer. A lot of creators and pundits out there are framing this as a super simple one-dimensional scenario. They're going to tell you OPEC is fracturing, supply is going to flood the market, and oil prices are going to zero. And yeah, sure, spot prices might see some short-term volatility, but producer margins, that is a completely different game. Pundits constantly confuse the price of the commodity with the actual profitability of the company extracting it. The underlying mechanics of this specific move tell a totally different story. For the most efficient producers, dropping that artificial price floor is actually the exact catalyst they need to capture immense long-term market share.
So here's how we're going to break it down today. First, we'll look at the cartel's freedom gap. Then, how they're front-running peak oil demand. Third, the U.S. shale depletion trap. Fourth, bypassing the Hormuz choke point. Fifth, the brutal retail ETF trap. And finally, the merchant producer alpha.
All right, let's jump right into Section 1, the cartel's freedom gap.
By early 2026, the Abu Dhabi National Oil Company, you know them as ADNOC, had aggressively invested in their infrastructure to build this massive, sustainable technical capacity of nearly 5 million barrels of oil a day. But the cartel had capped their output at just 3.4 million barrels. That difference right there, that is the freedom gap. Think of it like this. ADNOC has spent years and billions of dollars building the engine of a high-performance Ferrari. It is completely capable of dominating the track, but the cartel effectively forced them to drive it in a 20-mile-per-hour school zone. The whole traditional OPEC model rewards production restraint. It literally forces the most efficient nations to hold back their output just to artificially support prices, which basically serves as a bailout for less efficient nations with way higher extraction costs. So for a low-cost, super high-capacity producer like the UAE, this framework completely morphed from a protective shield into an absolute financial cage.
And that 1.45 million barrel gap between what they can produce and what they were allowed to produce, that represents over $21 billion in theoretical foregone revenue every single year. I mean, let that sink in for a second. That is enough capital to fully fund a massive space program or literally build a hyper-modern megacity from scratch, just surrendered year after year. And it was surrendered solely to subsidize the market share of less efficient competitors in places like Africa or Russia. When you compound that $21 billion over the massive multi-year investment cycles you need to maintain energy infrastructure, OPEC membership literally became a net negative anchor on the UAE's sovereign balance sheet. They didn't just want to leave, they simply outgrew the room.
Which brings us perfectly to Section 2, front-running peak oil demand.
To avoid being stuck holding stranded assets down the line, the UAE is transforming into something entirely different. They are pioneering a brand new asset class, the merchant producer. So think of a traditional cartel member, like a high-end boutique luxury brand, right? They artificially restrict the supply of their goods just to keep that price tag incredibly high. A merchant producer operates a lot more like Amazon. They completely decouple from those artificial price controls, and instead they prioritize sheer, overwhelming volume. Their ultimate goal is to absolutely dominate global market share and aggressively monetize their massive reserves while they still can. They are happily trading the cozy comfort of a price floor for the absolute leverage of total market dominance.
And the timing here is absolutely crucial.
The UAE is strategically timing this exit to front-run this structural decline of global oil demand. Now, major energy agencies might bicker over the exact month, but the general consensus projects peak oil demand hitting somewhere between 2027 and 2030. We're talking rapid EV adoption, massive grid electrification, and strict global efficiency mandates driving this. The UAE is currently sitting on over 100 billion barrels of proven reserves. In a future where overall demand is steadily shrinking, the energy market stops being this friendly cooperative game. It turns into a fierce, ruthless race to the bottom. It's basically a high-stakes game of musical chairs, where only the producer who can pull oil out of the ground for the absolute cheapest is actually going to find a buyer. So the UAE is leaving OPEC right now so they can sprint to the finish line and win that final race of the hydrocarbon era.
And they are backing up this strategy with some serious firepower. They aren't just blindly pumping more oil. They are deploying a highly surgical $150 billion offensive. Honestly, it's kind of funny to compare the global players right now. Because while Western oil executives are constantly sweating over quarterly shareholder buybacks and managing endless PR crises, ADNOC is treating its infrastructure exactly like a hyper-growth tech giant. They are embedding artificial intelligence natively across their entire value chain. And I don't mean using AI to write polite corporate emails. We're talking advanced seismic mapping, automated drilling, and optimizing massive reservoir management in real time. This crazy tech integration drives their costs down even further, making their barrels literally the absolute cleanest and cheapest in the world.
Let's pivot to Section 3 and see how this compares to the competition, the U.S. shale depletion trap. To really understand this dynamic, we have to look at the current engine of global supply, which is United States shale. For the past decade, U.S. shale operators have been the unquestioned global growth engine. But right now, they are walking headfirst into a severe inventory depletion trap. Think of drilling for oil kind of like picking apples. For years, U.S. producers have been picking all the low-hanging fruit, what the industry calls their prime Tier 1 acreage. Well, that fruit is running out. Now they're being forced to drag out the tall, expensive ladders to reach the harder-to-get apples in their Tier 2 and Tier 3 areas. Because of this added difficulty, their break-even costs are absolutely skyrocketing, climbing dangerously toward $80 or even $85 a barrel. Meanwhile, thanks to their prime geography and those massive tech investments we just talked about, the UAE maintains an unshakable lifting cost of just $15 to $25 per barrel.
This massive discrepancy creates what we call the margin cushion. Let's walk through exactly how a price war actually plays out. Let's say global oil prices drop to $60 a barrel. That producer in North Dakota or Texas, they start bleeding cash instantly. They're forced to lay off workers, shut down drilling rigs, and drastically contract their operations just to keep the lights on. But at that exact same $60 price point, the UAE is still comfortably pocketing $35 to $45 of pure profit per barrel. They don't have to contract at all. Instead, they happily gobble up all that global market share that those higher-cost U.S. producers were just forced to abandon. The margin cushion is what engineers the UAE to be the definitive last producer standing.
But of course, costs aren't everything. Which leads us to Section 4, bypassing the Hormuz choke point.
Because let's be real, having an incredible margin cushion and the absolute best AI algorithms in the world doesn't matter one bit if you can't actually get the physical product onto a ship. This brings us to the geopolitical note of logistics. The 2026 conflict has effectively blockaded the incredibly narrow 21-mile Strait of Hormuz. It's a geographical nightmare that has trapped roughly 10 million barrels of Middle Eastern crude per day inside the Persian Gulf. But here is the kicker. The UAE anticipated this years ago. They built the ADICOP pipeline, which quietly moves 1.5 to 1.8 million barrels a day directly from their inland fields completely over land straight to the port of Fujairah on the Gulf of Oman. This gives them clear water access straight to the open ocean and global markets, entirely bypassing the conflict zone that has completely paralyzed all of their neighbors.
This logistical masterstroke creates massive neutrality alpha. Let's break this down simply. When a major maritime choke point like Hormuz closes, oil that is already loaded on ships, which is priced against the Brent benchmark, becomes an incredibly rare, highly sought-after luxury. On the flip side, oil that is stuck on land in the middle of the United States, which is priced against WTI, creates a massive local glut because it can't easily reach global buyers. As a result, the difference in price between the two, what we call the Brent-WTI spread, blew out to a record $15 per barrel in April 2026. Because the UA pipeline bypasses the blockade entirely, they get to sell all of their oil at this massive inflated Brent premium. They are literally minting money from the exact geopolitical instability that is suffocating everyone else.
Now with these massive macro shocks happening, we need to talk about Section 5, the brutal retail ETF trap.
Because with these macro shocks driving prices into the stratosphere, we have to address a really brutal truth about investor psychology. I've got a stark reality check for you. Despite incredible oil price rallies over the last several years and historic geopolitical shocks that constantly dominate the news cycle, the inception-to-date return of the extremely popular United States Oil Fund ETF, ticker USO, is roughly negative 75%.
You're probably wondering, how on earth is a negative 75% return mathematically possible when the price of oil is actively spiking? Well, it comes down to the critical difference between paper oil and physical equity. Retail investors constantly rush into ETFs like USO thinking they are directly buying barrels of oil. But these funds do not own a single drop of physical oil. They own financial futures contracts. Think of paper oil ETFs like paying a massive reoccurring monthly storage fee for a warehouse full of oil you never actually get to use. Every single month, the fund is forced to sell their expiring contracts, often at a lower price, and buy the next month's contracts at a higher price. This structural penalty is called contango or roll yield decay. It acts exactly like a leaky bucket, silently draining 5 to 10% of your wealth every single year just due to mechanical roll costs. When you trade the headlines using paper oil, you are actively destroying your wealth. The real alpha is found by completely ignoring that paper illusion and instead owning the highly profitable, dividend-paying physical equity of the actual producers. Which leads us to our final takeaway in Section 6, the merchant producer alpha.
The UAE exits OPEC holding a fully verified 1.45 million barrels of spare capacity. Now, spare capacity in the energy market is exactly like having a massive, untouched cash reserve during a catastrophic stock market crash. Right now, U.S. shale is producing at its absolute maximum, redlining their operations just to maintain their current output. Other cartel members have severely strained or, frankly, completely overstated capacities. But the UAE, they have a massive, verified buffer. They are weaponizing the spare capacity as an instant financial option. Whenever a global crisis hits or another nation falters, they can instantly turn the tap, flood the market with their reserves, and capture immense risk premiums, making them the ultimate, unquestioned guarantor of Asian energy security.
As the traditional cartel fragments and completely loses its grip on global pricing, Abu Dhabi is successfully positioning itself as the independent central bank of oil. That $150 billion investment into AI and infrastructure scale isn't just about modernization. It provides a permanent efficiency multiplier. This multiplier makes them practically immune to the price volatility that routinely crushes their global competitors. Every single barrel they pull out of the ground today at a $20 break-even is worth exponentially more than a barrel trapped in the ground or restricted by some bureaucratic quota in 2040.
The UAExit is a complete paradigm shift that entirely rewrites the rules of global energy investment. The underlying data proves beyond a doubt that geopolitical neutrality, when paired with ruthless, AI-driven operational efficiency, is the ultimate alpha generator. So as we watch this historic 59-year departure fully unfold, you have a really distinct choice to make as an investor. Are you going to get trapped trading fleeting geopolitical headlines and throwing your money into the leaky bucket of paper ETF illusions? Or are you going to invest in the structural mathematical reality of the most bulletproof balance sheet in the desert? Think about that. Paper illusions or the last producer standing? I'll see you in the next explainer.